So today we continue our special episode about the stocks to buy and hold forever. Fellow investors, bonjour! This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. And I am with my co-host Vero for this special edition, second podcast of the week. We're going to definitely break some records here, but how are you doing, Vero?
Well, Mike, when you say records, I mean, I'm always doing good because you know how I want to grow this podcast. So listeners, just give us a thumbs up, hit subscribe, and leave us a 5-star rating. It means a lot. And this week, like you said, we celebrate our 200th episode with a 2-part series on the best 10 dividend stocks to buy and hold forever. Yesterday, we shared the best 5 US picks. You can go back to that episode at thedividendguyblog.com/200. And today is the time to look at the Canadian side. And let's not forget that most of them also trade in the US market, so they're interesting for all investors.
Yeah, and I often get that question during webinars or on social media. Oh, Mike, what would you buy now? And to be honest, I would buy exactly what I have in my portfolio. That doesn't change much because that's the whole purpose of investing is to buy and hold most of your companies kind of like forever. Unfortunately, things change, environment change, and business changes as well all the time. So we have to monitor those, but it's still the same intention. I want my stocks to be in my portfolio forever. So we're going to take a look at those. And today, I think all of them are in my portfolio. So you're not going to be surprised.
And again, remember, listeners, that you should not consider the stocks mentioned in this episode as buy or sell recommendations. Always do your due diligence before buying or selling an equity. All right, so yesterday we had 2 picks in the information technology sector, but today it's as Canadian as it could be with 2 financial stocks, Royal Bank, RY.TO or RY, and Brookfield Corporation, BN. While in the same sector, they have different business models. So what makes them good stocks to buy now and hold forever, Mike?
So, Royal Bank is the largest bank with TD in Canada and also by market cap. So, very big guy there. Definitely one of my favorite banks. We're gonna talk about the other one later on today, I'm pretty sure. But let's keep our focus on Royal Bank. So the reason why I think it's a buy and hold forever, it's for its diversification. So after 2008, roughly, most Canadian banks decided to take a specific strategy. So TD decided to go to the US, Scotiabank decided to go on international markets, BMO decided to focus more on capital markets, creating ETFs and on wealth management, and Royal Bank decided to go for everything. So they decided to diversify their portfolio of revenue, where today only 50% of its revenue is generated by classic banking activities such as savings and loans. The other 50% is linked to either capital markets, insurance, or wealth management. The biggest advantage I see here is the fact that if we have a mortgage crisis or if it's tough on the lending market, well, Royal Bank's business model will only be affected partially, while maybe they're going to be able to make money from capital markets or insurance or also wealth management. So it's a great way to always find a growth vector among different business segments, as opposed to a bank that would focus a little bit more on mortgages and commercial loans. Because if there is an economic slowdown, then they have no other ways to generate growth.
Right.
As for Brookfield Corporation, it's it's like holding a mutual fund altogether or a broad ETF because they invest in pretty much everything. So when you invest in Brookfield Capital, you invest in a alternative asset manager. So an alternative asset manager, what it is alternative assets are anything that requires investment that are not treated such as companies. So we can think about toll roads, we can think about data centers, we can think about um, pipelines, books of credits, insurance, real estates as well. So everything that requires patient capital. So we invest in infrastructure, we invest in energy, and it's for the long run. So Brookfield Corporation, as opposed to BAM, which is Brookfield Asset Management, is
Mhm.
asset heavy, which means that they not only gather capital from other investors, but also use their own capital. So whenever they sell an asset at a profit, it's going to be beneficial for them as well, as opposed to BAM, where if they sell an asset, investors are going to be happy if there's a profit, but they do not have money on the table. On the other side, there's also the drawback where if they sell an asset at a loss, while Brookfield Corporation will be affected, while Brookfield
Mhm.
Asset Management will just disappoint investors, but that's about it.
But Mike, what about your favorite national bank? I mean, are RY and BN showing a better entry point? What's going on? Why is it not
Yeah,
on
I
your list?
know, right? I'm not talking about National Bank in an episode of Buy and Hold Forever. Like, what's going on with me? My mind has not changed. I love National Bank, but for the purpose of this episode, for two reasons. I wanted to be a little bit more diversified and not always talk about the same stock. But most importantly, well, as much as I love National Bank and as much as I think it's the best bank right now to invest in, it requires additional follow up due to its size and its large exposure to Quebec, which is not the
Mhm.
case for Royal Bank. So I would be in for National Bank and Royal Bank always, but Royal Bank is bigger and even more diversified than National. So that's the main reason why I decided to highlight this one instead of my favorite one. And here's a funny story about the entry point because I thought
Mm.
that could be quite interesting. So, would you have loved to buy National Bank at 44 bucks?
Yeah, sure, of course.
Yeah, of course, right? Because it's trading at 125, right?
Mhm.
Well, you had that chance to buy it at 44 bucks in 2016 where the PE ratio was 13. And what's Any's price today? Well, trading around 125 bucks and the P about 12.5. So really,
Hmm.
if you thought that $45 for National Bank in 2016 was an amazing deal, well, you get exactly the same deal today. Or
Right.
maybe even better because now it's even more diversified than it was in 2016. So sometimes investors are making that mistake of looking at a stock price graph and giving any importance to the stock price graph. They're just like, oh, this company is trading at a all-time high, so I'm not going to buy it and I'm going to wait for a pullback. Well, it's trading at a all-time high because it has never made more profit than right now, and that's why you have
Mhm.
to pay for that. So you have to do a little bit more digging than just looking at a stock graph because the stock price graph doesn't mean anything.
All right, so let's go back to your two picks. What are the potential risks for Royal Bank and Brookfield Corp?
So, especially at this time, I think that for Royal Bank, the largest risk would be its mortgage exposure. So, they have a huge mortgage book. Considering the economy right now, maybe we're going to have a slowdown. We're still waiting to see if the Bank of Canada will successfully do its smooth landing by cutting down the
Mhm.
interest rate at the perfect timing just to give enough air to the consumers so everybody can continue to pay off their loans and keep the economy going. So if it's not the case, well, Royal Bank, as many other banks, will have to increase its provision for credit losses and take a hit on their mortgage book. So we'll have to see how it goes. I'm not that much worried in a sense where, yes, this could happen, but it's not going to destroy Royal Bank's bank model. It's just going to slow down its growth for a few quarters or maybe a few years.
Mhm.
As for Brookfield, well, first, it operates a highly complex financial structure. So complex that a lot of investors are pointing that out, and they're not happy with the homemade calculations of funds from operation and funds from operation payout ratios and the adjusted funds and so on. So there's a lot of opaqueness when you look at Brookfield's financial statements, and they have their ends into so many different businesses with so different percentages, and they keep on shifting their tickers and their structures. So it's really hard to follow. So if you're not willing to trust management on this one, and it's definitely a risk where we could eventually realize that management is actually playing around with numbers and those are big time wrong,
Mm.
well, we could have a big loss. So it's important to highlight this. I keep on talking about it, but so far so good. So it seems that some investors are kind of like ignoring this risk, but it's still there. The other one is it's asset heavy. So if they make bad investments, they're going to take the hit. So Brookfield
Right.
Asset Management is a little bit better on that side, where if they're wrong, well, investors are going to be upset, but at least it will not reflect it automatically on their earnings.
Okay, so now I'm sure that regular listeners are expecting the next one, so let's get it over with. Alimentation Couche-Tard, ATD. That's
Ta-da!
yes. um, so ATD has been on one of your darlings for many, many years, Mike. Why is it still one that you expect to hold forever?
Oh, more than ever, just because people are starting to ask questions after 2, 3 bad
Mm-hmm.
quarters. I just love when the good old media machines gets all the investors on board about the company's dead, and now the entire survival of Couche-Tard depends on their deal or no deal with 7-Eleven,
Mm-hmm.
which is kind of crazy. It's always the same thing, and I just love to see that. More than anything else, besides their business model, their locations. So they are literally everywhere. They own those locations for the most part. Yes, they lease some of them, but they have access to consumers. So whatever they decide to do with those locations, it's going to be a great advantage against any competitors. Their ability to adapt, it seems like a lot of investors think that the transition towards electric vehicle is the first time that Couche-Tard has to face a challenge and adapt. But I read the book from Alain Bouchard, and that was like so enlightening about on the very first day, they had to adapt their business model multiple times. There were a lot of different rules around convenience stores and laws around convenience stores throughout the years about like selling alcohol, selling tobacco products, and so on. So they have been able to always find ways to grow organically. So it's not just masking their lack of growth by making acquisitions, they
Mm-hmm.
grow both ways. They have this amazing strong culture of not paying too much. So I've seen so many like newspaper articles, videos, and a lot of interventions from analysts and other financial or investors about, oh, Couche-Tard's going to pay too much for 7-Eleven. They can't
Mm-hmm.
afford it. It's going to be a burden. I mean, my question would be, when was the last time they paid too much for an acquisition and that led them to drag for like 5 years, which was a mistake? It never happened. And we saw that several times where when the negotiations were not good at one point, while ATD just left the table. They just like, you know what? It's not worth it for us anymore. We're just gonna leave and we're gonna move on to the next idea that we have on our in our pipeline. And if it's not the right time or the right price or the right company, we're not willing to destroy shareholders' value and just like use their cash flow for nothing. So I really like that part. And I think that it's part just of the entire business model, not just one individual. So those are the reasons why I think Couche-Tard should be a hold forever.
But Mike, recent quarters have caused mixed feelings about Couche-Tard on the stock market. Is this like the consequence of potential risks or simply a rare buying opportunity?
I would say probably both, in a sense that, of course, that results were not good. I mean, I'm not the one that will hide. I've reported this on the Moose on the Loose, my 10-minute podcast, where I'm not happy when I look at Couche-Tard's results this year. I'm looking at
Mm-hmm.
this and I see like a company struggling to find growth vectors at this very moment and struggling to grow their earnings per share, but they do have a complete plan, and it's only normal that once in a while you hit a road bump and then you slow down.
Mm-hmm.
I also remember that I read similar comments in 2021 when the stock was trading around 40-45 bucks, and it was pretty much the end of Alimentation Couche-Tard back then. I remember that, and we kind of know like the rest of history. And ironically, as it is the case, as usual, no one came back to their statement saying, yeah, we kind of said that Couche-Tard is gonna die when it was trading at around 45 bucks, and we were pretty wrong on that. We never hear those stories, and I don't know why. Because I'm wrong. When I'm wrong, I'm coming back. I mean, all how many times we have discussed like companies like Algonquin and Sylogist, right? I
Mm-hmm.
mean, it's just
Right.
recurring topics. I'm not afraid to say when I'm wrong, because when you're wrong, you learn a lot as well. But I don't know. I guess it's not part of the financial culture. But anyways, so right now the risks are real, and Couche-Tard, I mean, they laid out a plan to grow organically, and now it's a matter of being able to execute that plan.
Mm-hmm.
They are failing this year. It doesn't mean that they're not going to fail in the future, but that's also a reason why we always must monitor companies like quarter after quarters. So of course, at one point I may be wrong on Kushtar, and that's going to be fine. I'm going to be the first one to talk about that in the 5 years from now. But in the meantime, we have to look at the dividend triangle. So if they cannot execute their 10 for the win plan for the next 10 years, for the next 5 years, well, we're going to see like revenue and earnings struggling like they are right now in 24, but in 25 and 26. And,
Mm-hmm.
and then the yield is going to come above 1%, and then it will be important to review my position on it, and maybe I will have to sell. So we'll have to see where it's going, but it's way too early to talk about that. I mean, for a company like this, I'm willing to be patient enough to wait for another 2-3 years just to see if the management is able to face the current challenges and turn things around.
Mhm. Let's take a quick pause to invite listeners to download the DSR Recession Proof Portfolio Workbook. This guide will empower you as an investor so you can stop doubting your decision and invest with more conviction. What type of tools will they get, Mike?
Well, actually, I created this workbook in 2020 during the pandemic crash to help my members to cut the noise and invest with more conviction. It was a tough period, and a lot of investors had a lot of questions. It's a workbook, not a book. It means that there's plenty of questions over there to help you evolve as an investor. And every year, I'm upgrading it, adding pages, adding content, and make it more complete. So when you know the answer, you don't stress about the question. And this is how you can invest with more conviction.
The DSR Recession Proof Portfolio Workbook is totally free. Visit thedividendguyblog.com/workbook and download it now. If you already used it, hit the comments and let us know how did it help you. Again, thedividendguyblog.com/workbook. Okay, Mike, Alimentation Couche-Tard is the only Canadian company mentioned today that is not trading in the US market. Americans could buy it using pink sheets, but is it worth it?
I mean, I really like Alimentation Couche-Tard, but trading over-the-counter stocks, it's not always easy, mostly because it's less liquid. So there are
Mm-hmm.
less investors buying and selling pink sheets than they are on the regular stock market. So it's just important to highlight that I would still go for it if I was American, but I would probably not be comfortable having a large position on it just because of that liquidity. So if there's any moment where I need to sell some Couche-Tard and I have to sell it as a pink sheet, I might run into some troubles, or sell it under the price that it's really worth if I have a large
Mm-hmm.
amount.
Okay, so the next stock on our list is an industrial one, Canadian National Railway, CNR.TORCNI. Of course, railroads are not about to disappear and they are hard to replicate, but what makes CNR one to hold forever?
I mean, this one is, it's the perfect picture for a company that you want to buy and hold forever because it's boring, it's
Mm-hmm.
repetitive, and it's constant. We need to transport. I mean, Canada is not a country that is going to shrink anytime soon, the US either. So transportation of good throughout large countries will remain an issue in North
Mm-hmm.
America.
Right.
And one of the best way to do it is to use railroads. And those railroads are almost operating like small monopolies in their area, or duopolies for sometimes. So that mode is just amazing. So we covered like Modi business a while ago during the summer, I think, on the podcast, and CNR came out as a strong company just for that. You cannot really compete with a railroad company. Trucking will get their fair share, but depending on the gas price and depending on what you need to move, you will either go for trucks or go for railroads, and that's about it. So I just love this repetitive type of business that is incredibly boring. I have CNR in my portfolio for, I don't know, I think I bought it around like 2010 or 2011, and I never looked at it really. I mean, I skim the earnings report, but you know what? They still do exactly the same thing as they did 10 years ago. So how surprising, right? And this is the reason why I will likely have it in my portfolio in 10 years from now.
Okay, so listeners, I will put the link to the Modi business episode in the show notes at thedividendguyblog.com/201. So, Mike, looking at CNR yield and PE ratio history, is it showing an attractive price, and what are the potential downsides related to the company?
Well, of course, while the business model is really solid, it still depends on the economy. So whenever you
Mm-hmm.
have a recession or economic slowdown, well, the need for transporting goods will decrease, and therefore, I mean, they still have to pay a lot of money to maintain their railroad network. So regardless if they use trains or not, they will still have to pay that. So it will have an impact on their margin. It will affect the earnings per share. And of course, whenever the market expects that there will be an economic slowdown, you might have a great opportunity to buy CNR at a cheaper price. There is also a very complex relationship between the operating ratio and the continuity of the business, in a sense where the operating ratio is a metric that we use to determine if a railroad company is profitable or not. So
Mm-hmm.
the higher they spend to maintain their network, well, the higher the operating ratio is, and therefore the less profit they're going to make. So the game is always to minimize the operating ratio while you do not put railroad maintenance at risk, because that's the other downside. I mean,
Right.
it would be easy to say, oh, we're going to drop the operating ratio at 25%, and then just don't care if like the railroad system goes sideways and
Not
needs
good.
like urgent repairs, which is not something that we want. So there's that like difficult balance to achieve where you want to have a healthy network that is like fully operational, and at the same time you don't want to spend too much. CNR has been very good doing this balance, but still every year it's an ongoing fight against expenses versus how much you can generate.
Mm-hmm. Mike, after all these years helping investors and retirees, we found a way to create a dividend income for life, and you will share this in our upcoming public webinar. So let's pause the episode a bit and invite you, listeners, to this special event. We will hold a live webinar on Thursday, November 28th at 1 p.m. Eastern Time. What will attendees learn, Mike?
Well, first, as a dividend investor, you just want to live off your dividend and enjoy your retirement. That's the ultimate dream. However, there is a big problem with dividend investing, and a lot of investors are blinded by the yield. So, we're going to talk about that. We're going to tackle the dividend myth. And I'm also going to offer you a different way to see how you can structure your portfolio with high quality company that will not fail you, and there you can still create that dividend from your portfolio. This is why we call it dividend income for life. We did that webinar last year to celebrate our 10 years anniversary at DSR. We had over 2,000 investors that watched that webinar. So I'm expecting a lot of questions for the Q&A. It's going to be a lot of fun. So I want to see you there on November 28th. And of course, if you register and you cannot attend, you will receive the replay.
So like you said, Mike, after the presentation, we will stay around for a 1-hour Q&A session. This is your chance to ask Mike your questions and get straight answers. Of course, the webinar comes with some freebies and I'll be in the chat to assist you. So save your spot now for the live session or to get the free replay at thedividendguyblog.com/webinar. Again, Thursday, November 28th at 1 p.m. Eastern Time. Create a dividend income for life at thedividendguyblog.com/webinar. So, Mike, I decided to keep the next one for the last because I believe it's the perfect example of a stock you buy and can expect to hold forever. It's the mother of Canadian dividend stocks. We could also qualify it as a boring but steady utility. So I'm talking about Fortis, FTS. What else makes it one to buy now and mostly forget about it?
You know how funny it is when I was younger, before I started investing in dividend paying stock, I authored the financialblogger.com, which I don't think exists anymore. But anyways, the thing is, I was like chatting with other investment bloggers and financial bloggers, and we decided to do some kind of like roundups of like what are the best stock picks for the year or whatnot. And one blogger actually is Mark from my own advisor, highlighted Fortis, and I was looking at Fortis back then, and I'm like, dude, that is so boring. I don't want that in my portfolio. I mean, like, what's the point? It's just like a 99% regulated utility. So they generate power, they transmit it to their customers, they get paid for it. That's the end of the story. Fast forward today, they now show 51 consecutive years of dividend increases, which is incredible, especially for Canadians. There's only one company, Canadian Utilities, that is doing better than Fortis for the consecutive years with the dividend increase. And that's exactly what you want. You want to use Fortis kind of like a bond proxy, or what I like to call them, a deluxe bond, which is a stock that I don't expect much from the stock price to move, but I count on the dividend to increase and beat inflation year over year and to offer a better total return than a bond. And since I invest 100% of my portfolio in stocks, having a few of Fortis in my portfolio will bring more stability. And that was also the first company that I just took away from the list to company to check when there was a COVID outbreaks. So during the lockdowns, I thought, well, I think we're still going to need power. So we're pretty safe on this one. So I don't have to monitor Fortis. This one's going to be safe. I'm going to focus on other companies in my portfolio. So whenever there's a crisis, Fortis is going to be the first company of my portfolio that I'm just going to disregard and just ignore, because they're just doing exactly what they used to do 50 years ago, and they're going to keep on doing it. Their management has been very solid. So yeah, very boring, not that much growth, but a very solid pillar in a portfolio.
And by the way, listeners, I'm just very happy to tell you that we will have a guest episode with Mark in the upcoming months, weeks. I'm not sure. I don't have the date yet, but I've discussed with him and he's in. So we should have him on the show pretty soon. So, Mike, as a regulated utility, is there a risk that Fortis would become too boring and not show enough growth?
Actually, yes. I mean, it's the case for any type of businesses. You cannot just simply close your eyes and ignore them forever. One thing that all utility business have to face is their debt. So if they have too much debt and at one point they lack of growth, so they cannot find ways, or they cannot convince regulators to increase their rate, well, then they may run into a problem, as interest rate will become a huge burden on their balance
Mm-hmm.
sheet. The other thing is Fortis is known to grow by acquisition as well. So when you acquire utility assets, as it is the case for any other types of acquisitions, there's always a risk of integration. There's a risk of paying too much, and there's a risk for the balance sheet again, because now you're not only growing your debt to maintain your grid, your power grid, but also you increase your debt to make those acquisitions. So that's why I like to just look at Fortis as that deluxe bond that I just described. And instead of
Mm-hmm.
expecting Fortis to drive my portfolio to high single digit or double digit returns on a good year, I just want to create some stability here. And I'm not too worried about the total return on this one, because its function in my portfolio is to create that stability and not to create the growth.
So, Mike, we recently did an entire episode on the dividend triangle and how it covers all angles. Listeners, you can listen to it at thedividendguideblog.com/195. The dividend triangle is also the base of our foundation of our investment strategy, as explained in our free portfolio workbook. How can this workbook help listeners find the best dividend stocks to buy and hold forever?
So the workbook is the perfect starting point if you're looking to adjust your strategy, or if you're looking to have a portfolio strategy all to itself. So we talk about sectors, we talk about portfolio buildings, we talk about what's important in your buying process, in your selling process. So we cover a lot of angles here.
Mhm.
Of course, everything goes back to the dividend triangle, but there's a lot more to learn. And this workbook comes with a list of questions, so it makes sure that you reflect on your portfolio and on your strategy, so you become more informed and more convinced, more comfortable with your investment portfolio.
So download the workbook now at thedividendguideblog.com/workbook. Well, thanks again, Mike, for this amazing list. I must admit, I'm ending this small series proud of myself because I hold 7 out of 10. It's not too bad,
Nice.
right? Listeners, remember to download your portfolio workbook at thedividendguideblog.com/workbook. For the show notes and related content, visit thedividendguideblog.com/201. Also, the last link I'm going to give you today, make sure to save your spot for our upcoming webinar at thedividendguideblog.com/webinar. And until next week, stay invested.
Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guide Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence, as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.